episode, we're going to be looking at institutional sponsorship candle. So we're going to be looking at the likes of the fair value gap, which are actually the frameworks of our efficient and inefficient price delivery. We're going to be looking at the order blocks. We're going to look at the breakout blocks, mitigation blocks, and rejection blocks. Then in the coming episode, we're going to be looking at the advanced theorem to the formation of order blocks. So let's begin with the fair value gap candles. So what we can see here is actually a bullish example. We have the bullish candlesticks. So what really do we refer to as the fair value gap? It is actually when you're having series of 3 candlesticks, and you can see in this example, we have a bullish candlestick. So the high of the first candle and the low of the third candle. If the weak low of the third candle and the weak high of the first candle are not in contact to each other, they create this gap in the market. That is what we call the fair value gap. Because you can see this is the high of the first candlestick and this is the low of the third candlestick. So you can see that there is a distance between the weak low of the third candlestick and the weak high of the first candlestick in between the second candlestick. So this is what we call the fair value gap, what we call the imbalance, or we actually call the inefficient price delivery, meaning we do not have a balanced price delivery. Meaning in this example you're seeing here, we actually have buyers' energy and the absence of sellers. Because you can see this is an impulsive bullish candle, and then the second candle is also an impulsive bullish candle. And then you can see when the third bullish candle was formed, we didn't have the presence of sellers pushing the market to actually mitigate the first bullish candle and the second candle, to actually show us that sellers also tried pushing the markets to balance the markets. What we can see is an impulsive movement of price to the upside. So you can see how the weak low of the third candle and the weak high of the first candle did not contact each other. The third candle, sellers did not push the price to the downside to actually fill up this gap. So this is what we call the fair value gap, meaning we do not have the presence of sellers in this bullish condition. So therefore, it is an inefficient price delivery. It is not a balanced price delivery. Buyers are more heavily present than the sellers. So this example you're seeing here is actually an efficient price delivery, because what you can see, we do not have a fair value gap. So you can see that this is the first bullish candle, and then this is the second bullish candle, and we have the third bullish candle. And what you can see is the buyers pushed the markets to the upside, created the series of 3 candlesticks. Now you can see that in between the first candlestick and the third candlestick, you can see that price action actually returned to the downside to mitigate the high of this candle week. So you can see we do not have a gap. It is either price mitigates the high of the candlestick, that is the first candlestick, or the third candle weak low actually return to mitigate the body of the first candlestick. So you can see here we have the presence of sellers, because you can see we have impulsive bullish move. But then in this particular candlestick, the third candlestick, the sellers actually push the market to the downside to actually balance the markets, to not leave any form of gaps in the price action, to not leave inefficiency, to not leave imbalance. And then now you can see that now we have the bullish candle to the upside. So you can see we do not have what's fair value gap, or what we call imbalance, because you can see that the weak of the third candlestick actually mitigates the weak high of the first candlestick. So it is either you can see that the weak mitigates the weak high, or the third candlestick weak may mitigate the body of the first candlestick, so that we do not have any inefficient price delivery. So this is actually an example of an efficient bullish price delivery. This is an example of an inefficient bullish price delivery. So let's actually check the bearish market condition. So this is actually the bearish market condition. And as you know that the bearish market condition is a downward movement price action. So what we can see here is that we have the first bearish candlestick, the second and the third candlestick, the bearish candlestick. Now what you can see to actually identify your fair value gap, meaning it is the low of the first bearish candlestick and then the high of the third bearish candlestick. So you can see from the low of the first bearish candlestick in between the second bearish candlestick and then the high of the third bearish candlestick, we have this fair value gap. So meaning we do not have the presence of buyers in this price delivery. So meaning this is an inefficient price delivery. It is not a balanced price delivery, because we have what? Impulsive bearish movement to the downside. Sellers did not actually allow the buyers to push the markets to the upside to fill up this bearish candle and mitigate the first bearish candle weak low, or the candle body low of the bearish candle. What we can see, we just have what? The impulsive bearish movement of price to the downside, leaving this imbalance in the markets. So for the efficient price delivery, what you're going to see is that we have this series of bearish candlesticks to the downside. You can see that the weak low of the first bearish candle and then the weak high of the third bearish candle actually mitigates each other. You can see we do not have a gap in the markets here. So we do not have what's the fair value gap. We do not have imbalance. So this is actually an efficient price delivery. So now you can see that the buyers pushed the price to the upside and then mitigated the weak low of the first bearish candlestick. So you can see now we have what an efficient price delivery in this particular market condition. So what you must understand is that when the market actually leaves fair value gap, the market will actually return to fill up that fair value gap. So this is a very important fact you must understand. So it is either price return to fill up the fair value gap completely, or price will return to the midpoint of the fair value gap to fill it up. So when we check chart examples, you'll get to understand. So now what we can see here in the chart is we have this bearish market condition. And so you can see that now price gave us this impulsive move to the downside. Price took out this low point. You can see price created this fair value gap from this candle weak low and then this candle weak high. Now you can see how now price took out sell side liquidity, broke the structure. Price returned to fill up the fair value gap. Price returned to actually give us an efficient price delivery. Because what we can see here is we have the massive presence of sellers in the markets. Now buyers actually return to rebalance the markets before we have the bearish continuation. So you can see in the market, what you're going to see is that the market will return to fill what the imbalances, the fair value gaps. So you want to look out for these fair value gaps within your premium or discount price level, depending on the market condition. In this particular episode, I just want you guys to understand how to identify the fair value gap. We're going to come to the application of this sponsorship candles. So now what you can see now, price return and then fill up the fair value gap. Now you can see we have this price action within this range or this high to this low. Now what you can see is price return to the downside, went back up to fill up this fair value gaps price created within this leg. Now price dropped to the downside to cut this low point. Now you can see price left this fair value gap. You can see how price returned to completely fill up this fair value gap and then price fell to the downside. So I told us guys in the institutional market structure video to identify ideal institutional market structure. I told us that the market actually moved to fulfill 3 things: fill up inefficiency, take out internal range liquidity, and also the external range liquidity. So now what we can see is that now price took out this low point, took out this external range liquidity. Now what you can see is that now price returned to fill up the what? Fair value gaps, to fill up the imbalance in the market. So I told us that at times you would see that price will not completely fill up the fair value gap. And this is an example of that. What you can see is that we have the return of price. Price completely filled up this fair value gap, completely filled up this fair value gap. Price return. And then you can see price return to a premium price level. So you can see how price returned to this fair value gap and then dropped to the downside. Now you can see that price did not completely fill up this fair value gap, but yet price mitigated the fair value. And then you see we have what? The fall of price to the downside. So you can see how price created fair value gaps also here. Now you can see how price returned also to fill up this fair value gap. You can see it returned again to this previous fair value gap, yet also did not completely fill it up. Price again fell to the downside to fill up this fair value gaps. So now you would see what imbalance price delivery in the charts. Price in the future will actually return to rebalance its price delivery. So now let's look at this example. This is a bullish condition. Now we can see how price took out this sell side liquidity. I told us how to identify ideal institutional market structure. You can go back to the 10th episode and also the 8th episode to actually look into that. Now you can see how price took out this sell side liquidity and then price pushed to the upside, and then we have break of structure. So you see this is a valid high point because it took out sell side liquidity, and then this is a valid low point because it took out the external range liquidity. So you can see that price actually gave us this fair value gap at the zone where price took out the external range liquidity. So you want to look out for fair value gaps that leads to a break in market structure. Yes, you want to look out for those kind of a fair value gaps, and which are also within your premium and discount price level depending on the market condition. Now we can see we have the impulsive move that got external range liquidity. Now we have our what's inducement, expecting to see that price will pull back and take out the inducements before we have continuation to the upside. So we can see price broke structure return. This is a valid pullback because it took out this candle's low point. So we have our first inducement, but then we have a transfer to this low point. So price pullback, and then we have this impulsive move. This is not our inducement. This is a minor inducement. This is our major. Now you can see how price left this fair value gap. Price return, filled up the fair value gap. Price again pushed to the upside to fill up this fair value gap price left. You can see here we have the drop of price. Now you can see that price filled up this fair value gap. Price again returned to the downside to fill up this fair value gap. And now you know that we have our inducement, expecting to see the price rate the inducement. So definitely below the inducement, what do we have? We have this fair value gap. Now you can see how price return mitigated the fair value gap. And this fair value gap is within the broken price swing points. And it is below the swing point itself. Now you can see how price returned to the downside, mitigated the fair value gap, and then we have the push of price to the upside. This is our inducement. This is our internal range liquidity. Price took out the external. We want to see price return to take out the internal range liquidity and fill up any form of inefficiency. And then we have the push of price to the upside. And you can see the price completely filled up this fair value gap. And slightly below also is another fair value gap. So you can see how price now even broke through this other fair value gap just to mitigate a portion of the fair value gap below this other fair value gap. And now you can see how we have the push of price to the upside. So again, let's look at this other example. I really want you guys to understand the concept behind this fair value gaps. So now you can see we have the push of price to the upside, price return to the downside, broke structure. Now what you can see is we want to identify our inducements. So we have the break of structure. This is the first pullback, and then price continued the movement. So this is our inducement. Price to cut external range liquidity. So we want to see the return of price to take out what? Internal range liquidity. So above the internal range liquidity, we want to be identifying fair value gaps or order blocks. But for this particular episode, I'm stressing more on the fair value gaps. We'll get to the order blocks here. So now you can see this is our inducement. Price to cut external range liquidity. So above the inducement, what do we have? We have this fair value. So you can see how price is return to mitigate the fair value gap. And then we have the fall of price to the downside. You can see price created this fair value gap. Price return, fill up this fair value gap. Price again return to fill up this fair value gap. Price now projected to actually mitigate the ideal fair value gap above the inducement swing high points. Now we can see the impulsive move of price to the downside, and then price what? Broke structure. So we have our high, we have our what? Low points. And now this is the inducement price created before the break of this swing view. Price again gave this pullback. So we have the transfer of inducement from this swing high to this other swing high point. So this becomes our engineered liquidity. And above the engineered liquidity, we have this fair value gap and this rejection block. So we're going to treat the rejection blocks in this episode. But then I want us to basically pay more attention to the fair value gaps. So you can see that this candle took out what? This buy side liquidity. And then we have the price created the inducement and the engineered liquidity. You can see fair value gaps. So now we can see how price is return. Price filled up the fair value gap. Yeah, price filled up this fair value gaps. But then we can see that this is actually the ideal fair value gap we should look out for, because this is where we have the rejection block. Price took out this buy side liquidity and then fell to the downside. Now you can see how price returned. Price mitigated the fair value gap and then price fell to the downside. Now we can see that price did not completely fall to the downside to actually take out this external range liquidity. Now this is the reason also behind this. Now if you're taking your entry from this fair value gap and your stop loss slightly above this rejection block high, you can see that even if this return to the upside, this will not take you out. So you can see now price actually continued the movement again to the upside to completely fill up this fair value gap, because you can see that this rejection block did not completely fill up the fair value gap. And then slightly above the fair value gap, we have the unmitigated order block. So that is why you can see the price return further to the upside to actually mitigate the order block and completely fill up the fair value gap. And now we have the fall of price to the downside. So you must understand that the market will create fair value gaps and then rebalance those fair value gaps. We're going to have inefficient price delivery, and then price would return to actually give us an efficient price delivery. So this is how you identify the fair value gaps. Now we're going to be looking at the order blocks. So you must understand that the order block is a specific price range or candle where institutions will be buying or selling against the retail perceived market condition or trend. The order block is basically the last price zone or level where the institutions have placed their orders before the main market move happens or before an ideal impulsive move happens, leading to market structure shift or breaking market structure. So basically the institutions leave order blocks for themselves to trade at a later stage. And one thing you must note is that you don't trade order blocks straight away. You wait for the price to come back to that order block, then you actually take your trade. So we actually have the bullish order block and then we have the bearish order block. So the bullish order block is actually the last sell candle before the bullish impulsive leg move. So it is what? The last sell candle before the bullish impulsive move. So you can see now, this is our bullish order block. This is the last sell candle before this bullish impulsive move that engulfed the bearish candlestick. So now this is the bullish order block. And you find this bullish order blocks within support levels or zones, while the bearish order block is actually the last buy candle that leads to a bearish move. And then you can see that this is where we actually have the last buy candle before the bearish move. So you can see we have moving a price to the upside, but then now we can see that price printed this last bullish candle, but then we are having this bearish candle that engulfed the bullish candle. So now we have a bearish order block, because now we can see that the markets fell to the downside. While in this condition, you can see we are having a bearish movement of price to the downside. Then you can see this bullish movement that engulfed the last bearish candle. And then we are now in a bullish condition. So the bullish order block is the last bearish candle before the bullish impulsive move, while the bearish order block is the last bullish candle before the bearish impulsive leg move. So now, what you must understand about the order block is that institutions will actually leave these order blocks and then return to use them as sponsorship zones whereby they take their entries. So now we can see that the market is actually falling to the downside. So you're expected to see a continuation to the downside. But this is where now the institutions actually now lead to a reversed market condition. So from a bearish market condition, the institution sponsored a bullish market condition. So what we're going to be expecting is to see that what price will return to the downside to mitigate the bullish order block. And for you to actually identify an ideal order block, then the order block should actually take out liquidity or print fair value gaps in the markets. So now what we can see is that now price gave the impulsive move to the upside. Now what we can see is above the order block, we have this fair value gap. We also have this other fair value gap. So you want to take your entry, you want to wait for price to return to the order block before you actually execute your entry. Now you can see that this bearish candle took out this candle though. But then this bearish candle that took out this candle was violated by this bullish candle. So it took out this liquidity, but then it was broken to the upside. So you can see how this bullish candle engulfed the last bearish candle. And now price left this fair value gap. You can see we have this impulsive movement of price, leaving inefficiencies. So price would return to fill up the inefficiency and mitigate the sponsorship candle where the institutions actually manipulated the markets. Because you're seeing a bearish movement, but then the institution initiated a bullish movement. So the same also applies to the bearish order block. You can see we're having a bullish market condition, but then the institutions now sponsored a bearish market condition. We can see the impulsive leg move, leaving price inefficiencies. Now the expectation is to see the pullback of price to fill up the inefficiencies and also mitigate the order block. And then you have the bearish continuation to the downside. So this is what you should be looking out for in the order blocks. You want to see an order block that takes out liquidity and then leads towards a break of structure. Because you can see that the impulsive move to the downside took out this bullish candle movement to the upside. It took out the low. So your expectation is to see the pullback for price to mitigate the order block, and then you have the continuation of price to the downside. So now, how do you then identify ideal order blocks? Just the way I've stated. Then you want to look out for order blocks that are sticking out liquidity. That is one. And then you want to look out for order block that prints fair value gap and then leads to a break in market structure. So for this particular example, you can see this is actually the last bearish candle before the impulsive movement of price to the upside that took out this high point. We have this break of structure. So you can see this is a valid order block because you can see we have fair value gap, broken structure, and then price took out this liquidity. Price took out the low of this bearish candle, but then this bullish candle now gave us the bullish move to the upside that took out this high because you expected to see more bearish continuation. But then the institution initiated the bullish move at this particular price low point. So now what we can see is this is the ideal order block. This is the last bearish candle that sponsored the bullish move to the upside that took out this swing high. And you can also see we have what's the fair value gap. But what you're going to notice is that this is actually the last candle, the down close candle before the bullish move. What we can see is that this bullish candle took out the low of the down close candle, the bearish candle, before we actually have the push of price that took out this high point. So we can mark out this bullish candle as the order block. But this is actually the down close candle that sponsored the bullish move. But the fact that this took out this low, took out the liquidity of the down close candle, the last down close candle, we can actually now just mark the bullish candle as the order block. And you can see we have what? The fair value gap. So this is an ideal institutional bullish order block. We have the rate of liquidity, we have the fair value gap, and then price took out the swing high points. So you want to see two of these criteria, or the three criteria, that the market takes out liquidity, leaves fair value gap, and then breaks market structure. Now we can see the further push of price to the upside. And then now you can see that now we have the return of price to the downside. So you can see this is the down close candle before the bullish move to the upside again. And what you can see is that now this down close candle took out liquidity, took out the low of this bullish candle. Now this is not the order block. This is the order block, because this bullish candle is just price movement within this bearish candle. Because you can see that the low is protected, the high is protected. It is now this bullish candle that took out the high. So this is our ideal order block, because this is also the down close candle before the bullish move to the upside. And the down close candle took out this liquidity and then sponsored the bullish move that took out this high point. So we also have another valid institutional bullish order block. Price took out liquidity, price creates fair value gap. The expectation is to see price return, fill the fair value gap, and continue bullish. Now in this other example also, you can see that this is the last down close candle. So basically the bullish order block is actually the last down close candle before the bullish move. Please, you guys should take note of that. The bullish order block is actually the last down close candle before the bullish move. So now what we can see here is that we have, this is the last down close candle before the bullish move of price to the upside that took out the swing high points. So meaning this is our order block. But what we can see is that this bullish candle returned to the downside and mitigated the last down close candle. So you can see this weak mitigated the body of the bearish candle. So this is actually our bullish order block. But then we can mark out this bullish candle as the bullish order block, because this further made a movement to the downside that took out this candle's weak low points. When we continue further, you get to understand the theorem of rejection blocks. So this form of order block looks like the rejection block. When we get to the rejection block, you'll get to understand it more better. So now what we can see is now this bullish candle took out this bearish low. So we can just mark out this as the order block. But what we can see is that we have this bullish candle mitigated this bearish candle. So we do not have fair value gap. So meaning our order block switches from this bearish candle, this down close candle, and even from this bullish candle to this other bullish candle, because now we have the fair value gap. So we have the transfer of the bullish order block from this order block to this order block. So from this candlestick, we have a transfer to this candlestick. So this is where we have now the ideal order, because this is where we have the fair value gap. So this is our last down close candle before the bullish move that sponsored the break of structure. And then this is where we now identify the order block, because these took out liquidity, but then price return mitigated. So we do not have fair value gap. So meaning we mark out this candle as our ideal order block, because we have the fair value gap here. So we're expecting to see the return of price to actually mitigate the fair value gap, and we have the continuation of price to the upside. And what we're going to observe again here is that now price broke structure. Price created this down close candle before we have the bullish move that took out the high points. So we can see that price left this fair value gap. So this is actually also an order block. But we can see that we have a missing criteria, which is actually that this down close candle did not take out this candle low points. So meaning it is an inside bar, because its movement is within the high and the low of this candle. So we do not have this candlestick, the weak, moving sufficiently to the downside to take out this bullish candle with low points. And then we have this bullish move to the upside that took out the high. From the theorem of marking out the last down close candle before the bullish move, we can see that this is actually an order block, because this is the down close candle before the bullish move. And then it also left fair value gap. But we have the missing criteria of taking out liquidity. So we could see price actually return to fill this fair value gap. But then price may further move to the downside to actually mitigate this ideal fair value gap, because this took out liquidity, left the fair value gap, and then we have the continuation. So you want to actually see this three criteria: takes out liquidity, leaves fair value gap or imbalance, and then breaks market structure. If you actually want to work with the two criteria, it is also possible. But then for you to have more higher probability, you want to see an order block that takes out liquidity, leaves fair value gap, and also breaks market structure. So now guys, let's look at this bearish example. You can see now this is the last up close candle before the bearish move of price to the downside. So we have this as our order block. But then we can transfer our order block to this bearish candle, because this further pushed to the upside and then took out this candle's high point. So took out this liquidity, and then we have the fall of price broke structure. So you can see now price left fair value gap. So meaning we have an ideal bearish order block here. So now we can now see for the push of price again pushed to the upside, took out this high. We have price raided liquidity, and then price fell, broke structure to the downside. We have another ideal institutional bearish order block, because we can see price also left fair value gap. So we're expecting to see pullback to fill the fair value gap, and then price falls to the downside. Same applies to this other example. This is the last up close candle before the bearish move of price that took out the swing low points. So we have this as our order block, but then we can transfer it to the bearish candlestick, since this actually took out the liquidity, and then we can see price left the fair value gap. So we're expecting to see price return to fill the fair value gap, and then we have continuation to the downside. Now what we can see is that price gave us the impulsive move, price pullback, took out this candle weak high points. So we have this as the last up close candle before the further bearish continuation that took out this low. So we actually have a bearish order block, and you can also consider this bearish order block. But one of the challenges is that we do not have the three criteria actually fulfilled here. You can see we have price took out this liquidity, price sponsored the move that took out this low points, but then we do not have fair value gap. So we can see that price may possibly return to the upside, and regard this as a buy side liquidity. Price will mitigate the fair value gap and then continue to the downside. So this is actually a bearish order block, but not really the ideal institutional bearish order block we'll be looking at, because we can see that one of the criteria is missing, which is actually the fair value gap, the inefficient price delivery. So price may return to the upside, and then regard this as a buy side liquidity, since we have this fair value gap. Then we have price falls to the downside. So I want you guys to really understand this sponsorship candles. We're going to look at this candles from real-time chart examples. So now what we can see from this chart example is that we have this fall of price to the downside. Price gave the pullback. Price fell to the downside. If you guys actually have seen the institutional market structure video, how to identify ideal market structure, then you will understand why this indication is here. Meaning this candle validates the break of this low point. Now what we can see is we have our order block. This is the last up close candle before the bearish move that took out this low point. Now you can see price give us our inducements. We have price took out external liquidity. We have the pullback, price fell to the downside. Now what we're going to see is that price left this fair value gap, and we have our order block above the fair value gap. So you can see the up close candle is our order block, but we actually marked this other bearish candlestick. Why? Because this took out this liquidity, and then we have the fall of price to the downside. You can see now price left the fair value gap. Price created this low. So we want to see price return, because we have what's inefficient price delivery here. Now you can see how price returned to the upside, filled up the fair value gap, the imbalance, mitigated the order block, and then fell to the downside. So you can see that this order block actually fulfilled the three criteria. Price took out liquidity, sponsored the move to the downside that took out external liquidity, and then we can see price left fair value gap. Price left what's the imbalance. Price return mitigates the order block, fill up the imbalance, and now we have the fall of price to the downside. Now you can see the pullback. Price gave us this up close candle before more bearish movement to the downside. But what you're going to see is, if we should use our Fibonacci tool, we're going to realize that this price zone is not even within the equilibrium. So we're going to see that the market is going to violate this order block, because it is not within equilibrium price level or the premium price level. Now we can see that price actually returned to mitigate it, because this is actually an order block. It left fair value gap. Price return mitigated it and fell to the downside. But I would not advise you actually take entry from such order blocks that are not within equilibrium price level or premium price level in a bearish market condition. So that is what you can now see. Price actually now consider this, because we have this as a valid pullback. This is the last bearish candle. And then you can see the bullish candle took out the high of the bearish candle and then sponsored the bearish. So this is now the inducement. So now price returned to the upside, took out the inducement, because you have what? Inefficiency here. You have this fair value gap. You can see we have this impulsive bearish movement. So price returned to mitigate this fair value gap. Now price mitigated the fair value gap. Now we can see the fall of price to the downside. Price what? Broke the swing low points. So this is how you work. Identify the order block. You want to see an order block that takes out liquidity, breaks structure, leaves fair value gap. This actually took out this liquidity, took out this low, left fair value gap. Price returned, reacted, respected, and fell. But price takes this as the inducement, because you can see that when we should actually apply our fee, this is below equilibrium and also below premium price level. So price created this low. Price returned, took out the high. Price fell, but then price did not continue to take out the external. Price went back again to also still mitigate this fair value gap. And then we have the fall of price to the downside. So now in this other example, we have this bullish market condition. What we can see is we have the push of price to the upside. Price gave us this pullback. This is a valid high point because price took out this liquidity, the sell side liquidity. Price created this low point. We have the push of price, and we have this valid pullback again before we have price give us this impulsive move that broke structure. Because you can see that this candle actually took out the low of this candle. So we actually have this as a valid order block. So you can see price took out this low. We have the rate of liquidity, and then price gave the impulsive move that broke structure. So now we can see that now price returned to the downside. So this is not a valid pullback because this movement is an inside movement within this bullish candle. So meaning we have the impulsive leg move as this entire movement to the upside. Now this is where we have the pullback, because this is the highest candle, but then price pulled back and took out the low. So meaning this is where we have our inducement. Now price created the inducement, price pushed to the upside, created this high. But they would rather have the movement of price to the downside to take out the inducements to validate this as a high point. Now we can see then price fell to the downside and then price pushed to the upside. So now this becomes an engineered liquidity, because this is the first inducement, but then it has been transferred to this swing low point. So this is now our inducement, the sell side liquidity. Now price pushed to the upside, pulled back again. So we're expecting to see any further new high would return to take out this sell side liquidity to validate the high. Now we can see price pull back, price pushed again to the upside. So what we can see is that price created this order block. This is the down close candle before this bullish move. But price returned, mitigated it. So this is no longer a valid order block. Now you can see that now price created this as a sell side liquidity, because this pulled back and took out this candle high. This is the extreme high. So we have a valid pullback that went below the candle that is above all these candles. So this is the last highest candle. So this is the last highest candle, and then price pullback. So we have this as a valid swing low. So we have this also as a sell side liquidity. So our inducement was transferred from this low to this low, now to this low. Now what we can see is that now price fell, took out the inducement, the sell side liquidity. Price fell to push further to the upside. And then we can now see price return to the downside, fill up this fair value gap. Now what we are going to see is that we should understand where price is actually aiming at. Price is actually aiming at any sponsorship candle below this swing high point, because that sponsorship candle is what actually led to the break of this structure. And now that is why you can now see that price for the push to the downside took out the engineered liquidity and all the sell side liquidity. You can see how price was returning and filling up fair value gaps. And then price returned into this fair value gap, because you can see that this is the order block that sponsored the bullish move that took out this high point. So we have the order block and then we have the fair value gap. Now you can see how price returned to the downside to actually mitigate the order block and the fair value gap. You can see the order block took out liquidity, give the impulsive move that broke structure, and then we can see price left fair value gap. That is why you can see price return to retest, and then we have the push of price to the upside. So this is how you want to identify your order blocks. So in this bearish example, what we can see is we have price took out this liquidity. We have, this is the last up close candle before the bearish move to the downside that broke structure. So now we can see this is the last up close candle. Now price fell to the downside. We can see that price left this fair value gap. Now we can see price broke structure. Price gave us this impulsive pullback, fell, pullback. Price returned to fill up this fair value gaps. Price also returned, mitigated this other fair value gap. And then now price fell to the downside and broke structure. So you know that we are in a bearish market condition because we actually have a valid break of structure here. Now we're expecting to see a pullback to the upside. If we're expecting the pullback, we're not expecting to see that price would respect this order block because this is also a valid order block. This gave us the last bullish candle before the impulsive bearish candle that took out this swing low points. So now what we can see is that this is a pool of liquidity. And this is the last high point. This high point took out this liquidity. This is our order block and we have fair value gap. So we should expect to see that price would actually return to the order block because we have this pool of liquidity here. We have this relatively equal high points and we have this unfilled fair value gap. So now price returned to the upside, mitigated the order block, mitigated the fair value gap. And you can see the impulsive movement of price to the downside. And then price broke this low points. So this is what you should be looking out for. You want to look out for the order block that takes out liquidity, sponsored movement to the downside that takes out the external range liquidity. So now, in this other example, what we can see is we have the push of price to the upside, price return to the downside. We can see that this is a valid order block because it took out this liquidity. Price took out this candle low points, and then we have the push of price to the upside. Price pulled back. We have price created our inducements. Price pushed to the upside. So we can see how the return to the downside, return to the order block, because you can see price left this inefficiency, the fair value gap. So you can see price return, and then we have the impulsive move of price to the upside. So now you can see what happened here is you also have a valid order block here, because what we can see is that now price pushed to the upside, but then we have all these fair value gaps already filled up. Now price created this order block because this took out this liquidity, sponsored the bullish move to the upside that broke structure. Now we also have this order block, the down close candle before the upward movement to the upside that took out the high points. But what you're going to notice is that this bearish candle is within this bullish candle. The high and the low of the bullish candle is protected. So it is not really a valid order block. Price has a tendency to highly violate it. Now we can see this is where we have the order block. This took out liquidity, sponsored the move to the upside. Price left fair value gap, but then price returned to mitigate the fair value gap before pushing to the upside. So you can see where price would actually mitigate the order block twice. So now that is what actually happened here. Price violated this because this is not an ideal order. This is within this bullish candle. Now we can see price pullback created our inducements. So we know when we see price takes out external range liquidity, we're expecting to see the return of price to take out internal range liquidity. So we can see that price created this down close candle, left this fair value gap, price returned into it, and then pushed, creating the inducement. So we can see how price fell, but price did not respect this order block because it is not an ideal order block. Now we can see then price for the push to the downside into where we identified the ideal order block, even though we don't have the fair value gap. So price may mitigate an order block twice, which we can actually see here. But I want us to pay more attention to unmitigated order blocks when you're want to execute entries. When we treat the advanced theorem to order blocks, then you get to understand more regarding order blocks and how you can actually utilize them. But for now, pay attention to the one that takes out liquidity, leaves fair value gap, and also break market structure. So this is all to the very basics to the order blocks. So we're going to look at the breakout blocks, and then we're going to now look at the mitigation block and also the rejection blocks. Then in the next episode, we're now going to look at the advanced theorem to the sponsorship candles. So we're going to be looking at the breakout block candlesticks. These are actually violated or breached kind of order blocks. So what we can see is we have this movement of price to the downside. So basically we are having a downward movement of price. So we have the impulsive move, we have the pullback, price pushed to the downside, and then we can see that price took out this low. And now what we can see is that we're still expecting a pullback and then bearish continuation. But what we're going to see is the market will push to the upside and then raid or break through this swing high points, leading to a market structure shift. It can be a major market structure shift or a minor market structure shift. So basically, the breakout block is actually a sponsorship candle that actually takes out a previous swing low in a bearish market condition. And then price gives an impulsive or expansive leg move and then takes out the swing high that actually took out the swing low. So this could be a valid break of structure, or this could be price just actually raiding liquidity with a wick. So basically the breakout block takes out sell side liquidity and then creates an impulsive move that breaks the previous structural swing points that actually took out the sell side liquidity. So that is when we can now actually identify the breakout block. In this example, this is a bullish breakout block. So now, because we can see that now we have this impulsive move to the downside, which is bearish, took out this low, but then price gave us this leg move to the upside that took out this high. So we are expecting to see bullish market condition, because now price took out the swing low points that sponsored these low points that broke structure or just took out liquidity with a candle wick, and then price gave an impulsive move that took out the previous swing high points. So basically, when you look at this other image or diagram here, you can see that what I'm trying to explain is to tell you that the market will give us the impulsive move, the pullback. Price created the swing high. The swing high sponsored the move that took out this swing low, either with a valid break of structure or just raid the liquidity with wicks. And then we can see this impulsive move that would now actually break through the swing high points. So this is where we have the bullish breakout block. What we are expecting is to see the pullback, because this is actually a bearish order block, where we are expecting to see that price will pull back, mitigate the bearish order block, and then continue the movement to the downside. But then we would see that price give an impulsive move and then broke through the bearish order block. So the bearish order block is going to actually reclaim price and then push price to the upside. That makes the bearish order block now a bullish breakout block. So what we can see is, what I'm trying to say is this. You can see we have this bearish movement to the downside. Price gave us the bullish move, pullback. Price gave us now the bearish move to the downside. We have this break of structure because we can see candle body close below this swing low points. So you can see we have our bearish order block. We know we are in a downward market condition. So we have our bearish order block. This is the last up close candle before the bearish move to the downside that took out this swing low point. But then now we can see that the institution actually now pushed price to the upside and then took out the swing high points that took out this low point. So the expectation was to actually see the return to the bearish order block and then price continuation to the downside. But then price broke through the bearish order block and closed above the bearish order block. So this break of structure is actually a market structure shift. So it is leading to a reversal. So the market is no longer bearish. The market is looking forward to becoming bullish, because now we have this candle closing above the last swing high point that broke the previous low point, took out the sell side liquidity. And now price gave a bullish move that took out that swing high points. So price now creates a bullish breakout block. So the bearish order block becomes a bullish breakout block when price breaks above the swing high points. So how you actually want to trade these breakout blocks is actually to see a confluence of fair value gap. That helps to actually make the bullish breakout block or the bearish breakout block a solid breakout block to actually look forward to take entry from. So we could see the scenario where price may not have to necessarily leave a fair value gap beside the breakout block. But the ideal breakout blocks you actually want to be trading is the ones that actually leave a displacement beside the breakout block. So now we can see that price gave us this fair value gap. We have this displacement to the upside, broke the high, left fair value gap. So we can expect to see price return, which is actually what you're seeing here. So we can expect to see price return to fill the fair value gap, mitigate the bullish breakout block, and then we have price push to the upside. So this is an example of the bullish breakout block. The bullish breakout block is actually a violated bearish order block. So this is an example here in the chart. You can see we have this bearish market condition to the downside. Now we can see price gave us the swing low points. Price pullback, took out liquidity, created this swing high points. Now you can see that this sponsored the movement to the downside that took out this liquidity. You can see here we do not have a break of structure. We have price took out liquidity. So that is why I told us that was the breakout block would actually sponsor the break of the swing low or just the rate of liquidity. Now we can see in this condition, we have the rate of the sell side liquidity. And now we can see this massive displacement to the upside. Price left this fair value gap. We have this order block, the last down close candle before the impulsive move that took out the swing high points. So our expectation is to see a pullback to the downside. To mitigate the breakout block, this is the breakout block, because this is now the last up close candle before the bearish move to the downside. That took out sell side liquidity. So this is where we now have our bullish breakout block. And you can see the confluence of the fair value gap. So we're expecting the fall of price to mitigate the fair value gap in confluence to the breakout block that sponsored the movement to the downside that took out sell side liquidity. So you can see the bearish order block is now a bullish breakout block because price pushed to the upside and broke through it. It sponsored the move to the downside that took out liquidity, left fair value gap and was violated. So we're expecting a pullback. We're expecting to see it reclaim price to the downside. Now you can see our price returned to the downside into the fair value gap in confluence to the breakout block. And if you can remember in the fair value gap episode, I told us the price may not necessarily have to fill up the fair value gap in totality. So we can see this is the last up close candle before the bearish move that took out liquidity. Now price gave a reversed movement that broke through the high, created fair value gap. Now we can see the fall into the fair value gap in confluence to the breakout block. And then we have price push to the upside. So this is what you should know about the bullish breakout block. We're going to look at more examples in coming episodes. So now let's actually look at the bearish breakout block. Now for the bearish breakout block, we're actually in a bullish market condition. And then price creates the last down close candle that sponsored this bullish move to the upside that takes out the previous swing high points, either with a valid break of structure or with a rate of liquidity candle weeks. And then we can see that price will fall to the downside and then price will break through the swing low points, leading to a market structure shift. So we're dealing now with the bearish breakout block. So the bearish breakout block is actually a violated bullish order block. So we can see that price gave this bearish movement, created the last down close candle, and then price created a bullish movement of price to the upside that took out the previous high points, either with a valid break of structure or with a rate of liquidity through the candle wicks. Price returns to the downside and then breaks through the swing low points. So we're expecting to see that price will pull back. So the breakout block will reclaim price. Price will pull back, mitigate the breakout block, and then we have price continuation to the downside. So you can see we have the bullish breakout block and we have the bearish breakout block. So now what we can see from the candle example is this. We can see this is the bullish move. Price created a pullback. We have our bullish breakout block. This is our last down close candle before the bullish move of price to the upside that broke through this high. But then now we can see that the institution sponsored a bearish move and broke the swing low points, leading to a market structure shift because you can see that this candle body closed below the swing low. So you can see that the bullish order block is now a bearish breakout block. So our expectation is to see the pullback to the upside for price to mitigate the breakout block, and then we have price continuation to the downside. The ideal expectation was to see that price will break the swing high, take out the external range liquidity, return to mitigate the bullish order block, and then price continues to the upside. What we can see is that price returned to the downside and broke through the swing low, creating now a bearish breakout block. So since the bullish order block did not actually sponsor for the push of price to the upside, it is going to reclaim price and then send price to the downside, which is now acting as a bearish breakout block. So the breakout block takes out the previous swing high or rate liquidity, takes out the previous swing high by actually valid break of structure or by just actually taking the liquidity with candle wicks. So now what we can see here is actually a chart example where we have this bullish movement of price to the upside. And what we can see, we have this pullback to the downside, and this is the last down close before this bullish move that took out this high. So meaning this is our bullish order block because this is the last down close candle before the bullish move. And then price took out this swing high points. So we have the rate of this liquidity, not really a valid break of structure. So we identify this as our breakout. The last down close candle before the impulsive move that took out this buy side liquidity, this previous swing high points. And now we can see the displacement, and then the displacement broke the previous swing low points. Now we're expecting to see the price will actually return through the breakout block. Then we have the continuation of price to the downside. Because what we can see is this displacement filled up this fair value gap left here. What we have is this sell side liquidity. We have this inefficiency. So the market is being drawn to this inefficiency in the market. So we want to see price pulls back and then falls to the downside. And that is what we can clearly see here, that the market pull back into the breakout block zone, the bearish breakout block zone, because we have price took out this high, give the displacement, took out this low, candle body closing below the low, the pullback into the breaker, and then the fall of price to the downside. You can see how price filled up this inefficiency, and then we see how furthermore fall of price to the downside. So this is the bearish breakout block, and you've also seen the bullish breakout block. So let's also look at another example here. We have this movement of price to the upside. Price gave this valid pullback, and then price gave this impulsive move that took out this buy-side liquidity, that took out the external buy-side liquidity, that took out this swing high points. And then you can see we have the displacement that took out the low points, that sponsored this movement that took out this high points. So where's the last down close candle that sponsored this bullish move? So you can see within this retracement leg, this is the last down close candle that sponsored this bullish move that took out this high. So meaning this is our breakout block, our bearish breakout block. So we have this as our bearish breakout block. So our expectation is to see that what price will return to fill up this fair value gap from this candle high to this candle low is where we have the fair value gap. In confluence, you can see we have the breakout block. So we're expecting to see a pullback for price to retest the breakout, and then we have the fall of price to the downside. And as I've earlier said, that the market may not necessarily have to fill up the fair value gap. So let's see. Now we can see that the market actually returned to the upside. So we can see that actually price mitigated the fair value, but did not fill up the fair value. So if actually we were looking forward to take our entry from this particular zone, maybe at this particular price level, we can see that price not really returned fully into it and then falls to the downside. Price actually returned and mitigated the fair value gap before falling to the downside. So in the coming episode, we're going to look at more advanced sponsorship candle. We're going to talk about the inversion fair value gap, because it is a concept of the inversion fair value that actually influences this movement to the downside without further pushing into the breakout block. So this is what you should understand about breakout blocks. So we're going to look at the mitigation blocks. So the mitigation blocks are also a form of order blocks that gets violated. So what we can see, the difference between the breakout block and the mitigation block is that the mitigation block do not actually read the previous low points in the condition of a bullish mitigation block, because we can see we have this downward momentum pullback. Price created the swing high, but then this swing high actually failed to take out the swing low. And then we have the push of price to the upside that took out the swing high points. So we now have a bullish mitigation block here, because the expectation is to see this pullback and then price continuation. So we have price created this new high. We have price created the bearish order block. So the bearish order block failed to actually sponsor an impulsive leg move to raid the previous swing low points. And then now price actually pushed to the upside and then raided the swing high, where we actually have the bearish order block. So the bearish order block is now going to act as a bullish mitigation block. So it's going to reclaim price and then push price to the upside. So you can see that the mitigation block did not raid the swing low. The breakout block actually rates the swing low with either valid breakout structure or liquidity swing. So now we can see from the candle example here, we have the fall of price to the downside. Price gave us the bullish pullback. So you can see where we have the bearish order, the last up close candle before the bearish move to the downside. But then price failed to take out this swing low points. Then we have the push of price to the upside, and then price created this market structure shift. Now in confluence, the market structure shift is on, which is the bearish order block, which is now our bullish mitigation block. We're expecting to see a fair value gap. Price would now return, and then we see the push of price to the upside, which is actually what we are seeing here. Price will pull back, and then we have the push of price to the upside. So I said price may not necessarily have to leave a fair value gap in confluence to the breakout block. But for high probability, you want to see fair value gap in confluence to the breakout block or mitigation blocks. So now we can see that now in confluence to the mitigation block, price left this fair value gap. Price dropped to the downside, and we have the push of price. That is the expectation, because the bearish order block actually failed to break structure and it was violated to the upside. So now what we can see is a chart example here. We have this movement of price to the downside. Price fell, created this high, fell, price pushed to the upside. Now we can see price created this high point, took out this liquidity. So we're expecting to see that price will further push to the downside to raid this low point since we're in a bearish market condition. But what we can see is that now price actually failed to continue the downward movements to take out the swing low points. So what we can see is we now have to identify the last up close candle before the bearish move that failed to break the swing low points. So we can see this is the last up close candle that sponsored the bearish movement to the downside that failed to actually take out the swing low points. And then price pushed to the upside and violated the swing high points where we actually have the mitigation block. So now we have the words bullish mitigation block. But in this case, you can see that beside the bullish mitigation block, you can see that price actually returned to mitigate that as the bearish order block. And then price wanted to fall to the downside, but then price pushed to the upside. So we can see this created a form of a flip-flop, meaning price gave us a bearish order block, and then price now created a bullish order block here. So now we can now see that this is also a form of a confluence because the bearish order block zone created a bullish order block zone, and we can see a fair value gap here. So we can expect to see a push of price to the downside and then continuation to the upside to take out this liquidity, fill up this inefficiency. So, and that is what we can now see happen here. Price returned to the downside. You can see mitigated the fair value gap because we have the order block. So price returned. So the mitigation block, which established another confluence of an order block, then we can see that price return mitigates, and then we have the push of price to the upside. So now we're now going to look at another example. You can see we're having this bearish movement price to the downside. Price gave us this pullback. Price failed to push to the downside to take out this swing low points. Now we can see this push up price to the upside. Price took out the swing high points. So you can see this is the last up close candle before the bearish move to the downside that actually failed to take out the swing low points. And you can see we have fair value gap beside the mitigation block, the bullish mitigation block. So we're expecting to see the fall of price, and then we see price push to the upside. So you can see this is our mitigation block because it is the last up close candle before the bearish move. And we can see fair value gap here. So now we're expecting the fall of price, and then we see price continuation. And that is what we can actually see here. So we can see how price returned, filled up the fair value gap, price pushed to the upside, price filled up this fair value gap, and then still decide to fall back to the downside before pushing further to the upside. So this is actually how you now identify the bullish mitigation block. It is actually a violated bearish order block. So for the bearish mitigation block, what we can see is that price pushed to the upside, we have the pullback. So price created the swing low point. We're expecting an impulsive move to take out the high, but then price failed to create that impulsive move to take out the high. We actually have a bullish order block here. So the violated bullish order block becomes the bearish mitigation block. Since price created the bullish order block and then failed to actually take out the swing high, and then price actually dropped to the downside and violated the bullish order block, now acting as a bearish mitigation block. So we want to say reclaim price and then push price further to the downside. So this is actually a candlestick example to that to explain it clearly. We have the bullish move, we have the fall. Price created the bullish order block. Price pushed to the upside, failed to take out the high. And then we have the fall of price that took out the swing low, leading to a market structure shift. So we're expecting to see in confluence the fair value gap and the bearish mitigation block. We want to see price return, mitigate, and then falls to the downside. So we're going to look at more advanced theory to this. So you can see this is a price to cut the swing low. So we're expecting to see push to the upside, mitigate the fair value gap and the bearish mitigation block. And then we have price continuation to the downside. So this is a real-time chart example. We can see the bullish move to the upside. Price gave us this impulse. We have this pullback. Price pushed to the upside to cut this high, fell to the downside. Price now pushed to the upside, failed to break this high point. So you actually want to identify the last down close candle before the bullish move that failed to take out this high, because we're in a bullish market condition. And you can see this is the last down close candle. And in confluence to that, we have this fair value gap. Price gave us the push to the upside, failed to break the high. Price gave the displacement to the downside and then broke the low points. So we can see that price is targeting to take out this sell side liquidity, fill up this inefficiency. So our expectation is to see what pullback. So you can see we identify the mitigation, the bearish mitigation in confluence to this fair value gap. And now what we can see is price return to the upside, filled up the fair value gap, mitigates the mitigation block zone, and then we can see how price fell to the downside. Price filled up this fair value gap, pushed to the upside, returned to this fair value gap, and then fell to the downside. So this is what you really need to know about the breakout blocks, the mitigation blocks, the order block, the fair value gaps, which are also our efficient and inefficient candlesticks. So now we're going to look at the rejection blocks. So let's actually look at the rejection blocks. The rejection blocks are actually a form of an order block, but they're actually identified from a different perspective compared to the order blocks. The rejection blocks are more of long wicks candlesticks. So what we can see here, we have this series of candles. We have this bullish candle, and then we have this other bullish. So what we can see is that we're having a bullish movement to the upside. Now price created this bullish candle with this large volume. Now what we can see is this other bullish candle opened at this low. Price pushed to the upside, but then price faced rejection. That is why you can see this long wick. So the rejection candlestick are actually long wick candlesticks patterns. So now what we can see is we have this long wick. And then what we can see next is that we have this bearish displacement to the downside. So this makes this a rejection block, because you can see that now we have this candle wick high, and then you can see this is the highest candle. So the rejection block actually forms at swing low points or swing high points. So now we can see how this candle here faced rejection to the downside, meaning this candle reacted at a resistance sponsorship zone, and then we see this sharp rejection. So meaning the bullish momentum is now weak. And then what we can see that the third candle is now a bearish displacement to the downside that engulfed the rejection candle. So we can see that the bearish candle and the rejection candle itself will have relatively equal bodies, because this is now the close of the bullish candle, and then now this is now the open of the bearish candle, and then we have this displacement to the downside that engulfed this bullish candle that has this long wick. So the same thing for the bearish condition. We're having the market movement to the downside. So you can see we have this 1, 2, 3. So the second candle here is the rejection candle, meaning this price is reacting at support level or reacted at support level and then faced rejection to the upside. Price could not continue further bearish. The sellers pushed the markets, but then the buyers came heavily and then pushed it back upwards. So now we can see that now the next candle that was formed was now a bullish candle to the upside that engulfed the rejection candlestick. So rejection candlestick actually have long wicks. So we can see that this also took out liquidity, and then price pushed to the upside, gave us a market structure shift. If actually this, for example, is from a higher time frame, in a lower time frame, we're going to see a market structure shift. Give us this engulfing candle that closed above the high of this rejection candlestick. So they are formed at swing points, either swing low or swing high. You can see this was formed at the swing low points, this at a swing high points. So you can see it takes out liquidity of the previous candle, or it can take out liquidity of a previous session or a previous swing point in the markets. So these are the rejection candles. And then you can see that the close of the bearish candle, bearish rejection candle, you can see that we have the body is relatively equal or equal to the bullish that engulfed the rejection candlestick. So now we can look at from real-time chart example. We have this market pushing to the upside. Price returned to the downside and then took out this sell side liquidity, took out this low point. You can see how price gave this bearish movement to the downside. But then we have the rejection to the upside. You can see this long wick, and then we have this bullish movement that took out this high point. So in the future, we'll be looking at price actually returning to this rejection candlestick. So you can see scenarios where price mitigate candle wicks. So those basically are form of rejection candles, because now the rejection candle forms a long wick, and then we're expecting to see price will actually return to mitigate the wick, either the mean ratio, which is a 50% of that candle wick, and then we see price push to the upside or downside depending on the market condition. And you want to actually trade a rejection candle that also leaves fair value gap. That makes it more effective. It takes out previous swing low or swing high liquidity and then creates a fair value gap and an impulsive move in the opposite direction. So you can see price was falling to the downside, took out this liquidity, and then price gave this impulsive move, took out this high, created this fair value gap. So you can see this candle gave us the swing low point, and then we have the push of price. You can see this is the close, and then the open of the bullish candle, and then the impulse to the upside that engulf the rejection block candle. So now what we can now see now, price return. Price filled up the fair value gap, but then price returned to mitigate the wick. So wicks also are sponsorship zones, basically where you identify your rejection candlestick. Now price pushed to the upside, created another rejection candle. This swept a previous session high point. Now price rejected to the downside. Now we can see the fall to the downside. Price created fair value gap here. So this is our rejection candle. So rejection candles basically have long wicks. So now what we can see is that now price gave this pullback. Price did not return to retest. Price just mitigated this fair value gap. We have a fall to the downside. Price now return. and then took out this buy side liquidity. We have this rejection candle. You can see this long wick, and then price fell. So we can see in the future the possibility that price will return to mitigate this candle wick and then falls to the downside. So this is what you actually want to see in the markets, how to identify rejection blocks. So there are a series of 3 candles, and then you want to look out for the candle with the highest points that created a long wick. So that becomes your rejection candle. So now, what we can see here from the chart is we have this fall of price to the downside. Price pullback created this high, price fell, price return. Now you can see that this took out the swing high points, mitigated this fair value gap, filled up this fair value gap. Price fell to the downside, broke structure. Now what you can see is price now pulled back. So before we have the break of the swing, you can see price created the inducement and then fell to the downside and broke structure. So now we can see that this is the minor inducement. Price fell, took out this low, pulled back, fell, took out this. So this is the minor inducement. This is the major inducement. So you can see now price returned to the upside. So you can see how here price did not return to mitigate the main threshold, but price returned into the rejection block, to the high of the rejection block, and then price fell to the downside. So what you can see here is that price also took out this buy side liquidity. Price created another rejection. You can see 1, 2, 3. This is the highest candle. You can see giving us this long wick. You can see how now price returned to mitigate the wick and then fall to the downside. You can see there is no fair value gap, but wicks also are sponsorship zones. So you can see how price returned and fell. So you want to actually trade this candlesticks in confluence to the directional bias, the bullish order block, the bearish order block, the breakout blocks, the mitigation blocks. You want to trade them in confluence to the market direction. So now we can see this example again of a rejection block. We have 1, 2, 3. This is the lowest low. And then we have this long wick. Price took out liquidity, pushed to the upside, broke structure. Price here gave this fair value gap. Now we can see how the return of price came into the rejection block, to the main threshold of the rejection block, and then price pushed to the upside. Now we can now see price pull back again, back into the rejection block, mitigated the main threshold, push, return again, retested, and push. So this is how you identify rejection blocks. Take out possibly a swing low or high liquidity, and then they also now have long wicks. So for this one, you can see it took out this sell side liquidity. You can see the rejection. Price pushed to the downside. The sellers pushed the market to the downside, but then the buyers came and massively pushed it to the upside, and we have this movement that took out this external range liquidity. Price return mitigated it. So we're looking at the main threshold or the close if you are actually in a bearish condition. So now we can see how price again still return and then push to the upside. Price created another rejection block here. So there was a possibility of price possibly dropping to the downside to mitigate this other rejection block and then project to the upside. So this is what we should know about the rejection block. So let's check another example. So now here in this example, you can see how price took out the sell side liquidity. You can see this long wick, and then price pushed to the upside, took out the external liquidity, broke structure. We have our value pullback where we have the inducement. Price return, took out the inducement. You can see this left a fair value gap. But price did not mitigate the fair value gap and push to the upside. Price returned into the wick to the main threshold, and then we have the rejection again to the upside. So rejection blocks are actually candles with long wicks, and these wicks are also sponsorship zones. So you can see how price returned and then push to the upside. Price gave us this pullback before pushing to break structure. So this is our inducements. Now you can see the fall of price to the downside. Price took out the inducement, returned back into again the rejection block, and then you can see how price again push to the upside. So the rejection blocks are like the other blocks, but these rejection blocks are actually long wick candles. So this is what you should know about the sponsorship candles. In the next episode, we're going to look at more of the sponsorship candles, the advanced theorem to the application of the sponsorship candles. This episode is to help you learn how to identify the sponsorship candles. So I see you guys in the next episode.